Greece continued to dominate the headlines this week. We've been really hanging on this decision by most of the private sector involvement in Greek bonds in signing up to this reorganisation of Greek debt. And earlier in the week, it was seen as potentially that they will not see sufficient votes to allow this to be carried through in the ordinary way, invoking what is known as the CAC. However, whilst that wobbled market certainly earlier in the week, as time has gone on, the private sector involvement and the votes, the leaks that are coming out are certainly suggesting at the time of this podcast that they will have sufficient, and an announcement is due by Friday morning by 6 a.m. is what we're hearing on the latest, and that really has been the major influence on markets this week. It sent markets quite sharply lower for its biggest one-day fall of 2012, but we have seen a virtually immediate recovery of most of those falls over the course of the next 48 hours. So still demonstrating a market that is buying into the dips rather than selling the rallies at this stage. It's also a week that we learnt that the UK economy has been demoted a further place in the world rankings. Brazil has now become a larger economy than the UK, recognising the huge growth that they're experiencing in trends and trades towards China at the moment. It is a changing world, and one which is being more and more influenced by the ability to be able to compete and be able to export to Asia growth. The UK at the moment is losing out in that particular battle, and countries like Brazil coming through with stronger growth, and aided this week by further rate cuts to their interest rate policy. So let's just take a look at the markets. The chart of the FTSE 100, I've overlaid it with the FTSE 250 because I just want to continue to highlight the trend that when we have risk off, as we describe it, and nervousness around markets, this bottom line here represents the FTSE 250. And you can see that the diverging performance was sort of magnified really in December. But since that period of time, we've seen a much more rapid increase in the FTSE 250 compared to the FTSE 100. And we've seen a performance which is probably in excess of double that in 2012, FTSE 250 over FTSE 100. Coming back to a year performance at the moment, which is now looking comparable. So that gap has now closed. The other feature of the week, as mentioned, is that we did see the biggest fall or one-day fall in the course of the year. It's probably woken the market up to some extent. The market was sort of getting very, very quiet, and that was represented by this chart, which is what we term as the fear index. It's a measurement of volatility, and you can see how that chart from the sort of Euro crisis was really just crunching lower to a level which was normally was seen as a market that was becoming sort of quite lacking a lot of volatility. But this little spike up here, it looks modest on the chart, but does represent that daily fall. So one to just keep an eye on over the course of the next few weeks to see if we're starting to enter more volatile conditions, or whether we're just going to see a sort of resumption of this sort of trend at the moment. I'm going to be watching that one quite closely. The other feature of the week was, for me, Spain. A lot of focus on Greece at the moment, but I think that deal is largely done. We will come back and revisit Greece for sure over the course of the next 12 to 18 months. But in the interim, I think that now the LTRO programme is out of the way, now that the firewalls are built, now that the banks have got some access to this liquidity, is it time for confession? The reason I ask that question is we take a look at the Spanish economy, and what we see there is that they're already revising their own forecasts for 2012 and 2013. They're widening the deficit expectation, and still the 2013 forecast of a 3% deficit feels to me like quite a tall order given where they expect it to be this year, which is nudging more towards 6%. As we've seen in this country, trying to bring down that deficit quickly brings a lot of social tension within the economy, and often it takes more courage than many politicians have the nerve for to be able to achieve that. So we're starting to see this with Spain. We did see a pop up in yields here. It looks modest on the chart, but it was quite a noticeable increase. But as the Greece situation has begun to look more positive, we have seen that softening. So hopefully it's not a chart that's going to cause us any concerns in the near term, but it is a dominant feature. I also want to just focus on some stocks this week, because one of the features that I've witnessed is again around this whole dividend policy. I've seen companies this week raising dividends by significantly more than expectations, and they are receiving rewards for that in the share price. WPP is one. I think the thought was they may increase their dividend by 20%. It went up 38%, and we saw there a move virtually back up to the all-time high for WPP. Likewise, Cobham was another company. You can see a very sharp spike in their numbers yesterday, and that again was caused by a much higher dividend policy than first thought. That stock is covered by our research team. And another company that is covered is Man Group, and again it's been a poor performer of late, and certainly the expectation during this period was that their high dividend policy would in fact be cut, but they've reiterated their guidance towards dividend policy, which has given the market heart. And again, whilst the chart looks relatively modest, take into account that since the middle of January this price now has increased by about 40% from the low point, and I think the dividend has been a major impact on that. Finally, commodities can never remain completely out of the story, and cotton is one which, just to keep a little bit of an eye on. I saw the results of Glencore this week, mentioned that they lost quite a lot of money trading cotton. I think the problem related to how they hedge their exposure to cotton through the futures market, and that was not tallying with the physical market. And we saw this week that India, for the second time, is banning exports of cotton. So cotton had a huge rise back in 2011, not necessarily shown on this chart, but from that peak. But it's just one to watch, as this is inflationary clearly for many of the retailers in the UK who have to buy their cotton. We just need to keep an eye on that price for raw material costs. Inflation is of course a key issue for the Bank of England. They're very confident in predicting that it's coming back to below their target of 2% at the moment, but with oil bubbling up and some of these raw materials bubbling up, it may be the case that they can be disappointed on how quickly that can come down.